Looks like we're live.
Oh, you can see it on.
Uh-huh.
Oh, no, mine's not showing. Okay, well, let's go ahead and get started. We're going to wait about another 2 minutes.
Yeah, let's do
That
it.
way we could go ahead and give people time to get here.
Yes, ma'am.
Have you been busy lately with approving people for new buyers?
It actually has been busy. On our end, as long as we're doing the activities, and really the number one activity that we need to be doing is educating. And that's what we've been spending a lot of time doing is just teaching and informing folks of why it's still a great time to buy. So,
Mhm.
yes, that's actually keeping us busy.
Well, that's a good thing. That's a good
It
thing.
is. Absolutely. We're very, very blessed. We're very, just excited. So, no complaints on our side.
Well, that's a good thing. Never complaints. Always busy. Real estate market is going. It's having its ups and downs, and a lot of people are not sure exactly which way to go
Yeah.
in the real estate market.
Yeah.
So it's about 7 o'clock. So we go ahead and get started. Everyone, my name is Linda Blue. I am a local real estate agent here in Houston, Texas, and we are joined by Ms. Veronica. Ms. Veronica, can you introduce yourself?
Yes, Veronica Villafana. I'm team leader for the Villafana Group with Streamline Home Loans located here in Houston.
Thank you so much. And I really appreciate you joining me because there's a lot going on with the real estate market. The interest rates are going up. A lot of buyers are getting scared. They don't know what to
Yeah.
do.
Yeah.
So I've had a couple of buyers who have actually canceled contracts because of the interest rates. And with the builders, because I do a lot of new constructions, they are starting to give more than incentives. They're starting to ask if you want to buy down. And a lot of people do not know what buy downs are. Sometimes they prefer to do a price reduction versus a buy down. And that's why I wanted to invite you on today for you could discuss the difference between a buy down and a price reduction. So
Absolutely.
so if you don't mind, go ahead and share your knowledge with us. And if anyone has any questions, make sure you drop them in the chat, and Ms. Veronica or myself will be able to answer those questions for you. Go ahead, Ms. Veronica.
Yeah, let's do this, Linda. So, as a mortgage lender, it's really important that we really understand all the solutions out there for homeowners, for future homeowners. And one of the biggest solutions that's out there for our homeowners, especially those that are really just nervous, just kind of scared to make that move, and is it still a good time to buy? What do I do next? Absolutely. So one of the solutions that we have on the mortgage lending in the mortgage lending world is something called it's called a 2-1 buy down, where it's just instead of speaking in a foreign language, it's considered a temporary buy down. Okay. There's a little bit of a difference between a permanent buy down and basically like a either permanently buying down your rate or maybe reducing the sales price versus working with something like a seller funded buy down or a temporary buy down that will help a home buyer to really maximize their dollar on a monthly basis and help ease them into that monthly payment where the current market rates are at. So if you're ready, I'm ready to jump into the nitty gritty. Are you ready to do this, Linda?
I'm ready. I'm ready. I'm so ready. Go ahead.
Awesome. Let's do it. So a seller funded buy down or a temporary buy down it's different from a permanent buy down. Okay. First, let's kind of talk about permanent buy down. A permanent buy down is when, let's say that a buyer tells you, hey, Miss Linda, I have a couple of $1,000 maybe from the builder, maybe from the seller that I want to apply towards lowering my rate. The big elephant in the room, our rates are rising, right? That's just the that's where we're at as a market, and this too shall pass. Okay, that's not permanent. And I've been in the business since 2005, so I've seen interest rates all across the board. Okay, so a permanent buy down is when you buy down your interest rate to get a lower rate for the life of the loan. So it's a one-time fee that you pay at closing, either from your pocketbook, from the seller's pocketbook, through like a seller contribution. And typically, a buy down, a permanent buy down through a discount point is usually about, let's just say, for example, I'm going to give just an estimate. Let's say maybe it's going to get you from a 6.5% to a 6.375 or 6.25%. Quite honestly, it doesn't affect your monthly payment a whole lot. Okay. What we're starting to see more of, and this has actually been out there for quite some time, it's called a seller funded buy down. So instead of, as you're getting money from, you're receiving money from the seller, in this case, let's say new construction with the builder or a resale home, instead of using that money towards a discount point where it's only lowering maybe your interest rate about 0.125 or 0.25%, which really doesn't make a big difference to your payment. It can just a little bit, but not a whole lot. What we're doing is a seller funded buy down. And what we're doing with the seller funded buy down is it's let's say, let's use a live example. Let's say, for example, and I'm going to use easy numbers. Okay. Let's say that your interest rate 7%, the note rate. That's your final interest rate. If I quote you 7% today, the way we work it out is year one, your interest rate would be a 5%. So it's 2% lower. So 7% note rate, your interest rate year one would be 5%. And that's how we calculate your payment, based on a 5% interest rate. The next year, year two, we're going to stair step your rate. So instead of 5%, now it's 6%. Okay, we're still not quite at 7%. So year one is 5%, year two is 6%, year three would be 7%. We settle into your final interest rate that we quote you from the very beginning. Okay. This is very different from an adjustable rate mortgage. That's completely different. So what we do is, we're going to take money from the seller. Okay, these sellers are in a position where they're really trying to move their inventory. They're trying to move their home, so they're giving a lot of incentives to home buyers to buy their home. Now, what we're doing is we're taking that money and we are putting that money. Let's just use $10,000. Okay, that's a common amount. We're going to take that $10,000 from the seller, from seller contribution, and we're going to set it aside into a savings account for you. It's what we call an escrow account, okay, as for a home buyer. Now, what we're going to do is every month, let's use an example of, let's say that your final monthly payment is at an interest rate of 7%. Let's say your payment's $2,000, okay, principal, interest, taxes, and insurance, all of it included. Well, year one, if your interest rate, if you're paying based on a 5% rate, then let's say that your payment is 1500. Okay. So every month, what we collect from the homeowner is 1500 every month. And then what we do is, from the money that is saved in your escrow account, we pull every month. So we collect 1500 from the home buyer, from the homeowner, and 500 from the escrow or the savings account, so that we, the lender, can pay the servicer $2,000. Okay, so that's year one. So every month, 1500 from the homeowner, 500 from the escrow account. So this escrow account is basically subsidizing the difference in the payment. Okay. Year two, as your interest rate goes up a little bit more, let's say it goes up to 6% in the example that we used earlier, then let's say that payment is 1750 now. So we take 1750 from the homeowner, 250 from the escrow account, and we pay, as the lender, we pay $2,000 to the servicer. So behind the scenes, the servicer is getting $2,000 a month from the get go. Okay. But what we're doing is we are using this solution to help the homeowner ease into that monthly payment. Well, as a homeowner, if I get to save $500 the first year, $250 the second year, you know what I'm doing with that money? I'm paying off debt. I'm putting money in savings account. I'm doing something with that money to help me prepare for that $2,000 monthly payment that I'm going to have at year three. So basically, it's just, in short, it's a way to help ease the homeowner into that final monthly payment. And the cool thing is that there's no restriction, there's no rule that says that you cannot refinance if the rates drop between year one to year three. Part of the forecast is it's economists are forecasting that interest rates are gonna drop a little bit next year. Well, if if your final note rate 7%, but rates drop to, let's say, 4%, guess what? We're gonna refinance you. Okay. And that's a way to be able to reduce your monthly payment. But really, in short, that's all the seller funded the temporary buy down or the seller funded buy down. That's how it works.
So what I'm hearing is that a lot of people are getting scared because of the interest rate.
Yeah,
I've heard people tell buyers, and I've told my buyers also, marry the house, date the interest rate. And that's what it seems like it is, because if my interest rate is 7% and I love the house most likely is not going to go down an extra 50,000 or 100,000 a year or two. It's going to continue to go up. So we're
exactly.
trying to tell buyers, if you find that house, the interest rates are going to fluctuate. Get into that home, secure it, and continue to build your credit, because the higher your credit is, the better rate. Is that correct?
Exactly. So I'm going to add on to that. So date the rate, marry the house, divorce the rent.
That's a good one.
Yeah,
Because rent is basically 100% interest.
it
So people
is.
people want to stay, well, I'm going to stay put for a year or two. I'm going to wait till everything crash. If everything does crash, it's not going to crash to what you assume is going to crash to. So
Exactly.
there's still, even if the rates come down and the houses come down a little bit, it's still not going to be what it was 3 years ago, 4 years ago.
It's not. I've been in the business since 2005. So I got to see the before, the during, and then the after, which is the housing recession. And it really was what happened in 2008, 2009. That's not the norm. Just like COVID was not the norm. No one kind of could forecast that. No one knew that was going to happen. But yet here we are, surviving and thriving now after COVID. But absolutely, that was the market. I mean, if you look at, excuse me, if you look at what has happened historically with home values in the past several years, really since the housing recession in 2008, 2009. Home values have continued to rise every single year. Linda, I bought my house in 2006 at a 6.5% interest rate. Okay, which is normal in in what you're seeing in today's market at 6.5. When I sold that house about 7.5 years later, I made, and here's me being transparent, that profit was $80,000. Tell me an investment, a 401k, an online investment, crypto that's going to give you an $80,000 return. If I could go back to my 22-year-old self when I bought my house at 6.5%, I'd say, you go, girl, do it all over again because it absolutely was worth the sacrifice.
And that is so true. And I tell people a lot, your first home doesn't have to be your dream home. We want you to get your foot in the door, because you can always be there for 5 to 7 years, build up
Yes,
that equity, then
yes,
turn around and build and go up on, on the style of house. It,
yep,
depends on where you are in life. So never try to buy your dream home at first if you can't get it. Get into something, own some sort of real estate. That way you have that position. And when things are going crazy like it is today, you have all the equity in your
yeah,
house where you're able to sell it and put it towards another home and go and, get something
absolutely.
that you really want.
Absolutely. In during COVID years, we were seeing homes appreciating as much as like 15, 16% year over year. Now things are more normalized. We're going to see appreciation maybe 4 or 5%, but still show me an investment. Guys, my savings account is giving me like 0.1% on a good day. My 401k, I have lost year to date, and it hurts so much to see where my 401k is sitting, but that's just where the market is. But gratefully, let me share this with you, Linda. When I had so that first house that I bought it when I was 22, when I didn't know what in the world life was all about. I thought I knew it all. But the one smart decision I made was I bought a house. So fast forward 7, 8 years later, I went through divorce. Okay, life happened. And through that divorce, so I wish I could have walked away with that whole profit, but hey, life is life. We split the difference. And so I took my half, and the money that I had as a 30-year-old, I was able to take that. I then bought my next home with ease. I actually downsized because it was just me and my son. I didn't need a whole lot of space. I downsized, I upgraded my vehicle. I needed a better car. I paid off debt. I had gotten into debt, and I had a very comfortable lifestyle. I wasn't rich by any means, but I was very comfortable. And that felt good because post divorce, post life, I felt good. I was confident that I was going to be okay. And guess what I did with that house? I've met the man of my dreams. I have remarried. I have built this new life together with my best friend and business partner, and we kept that house as a rental property. And so now you want to talk about building generational wealth. That home, I already committed to my son. I said, "Son, that is your home. That's going to be for your college. It's going to be for, now I'm not going to give it to him. He's going to have to earn it. But that home that we have, as you know, that we have tenants renting,
Mhm.
everything in season. Okay, I was a renter for a while as well, but they're they're paying something that belongs to me, and I'm building equity, and that's how real estate works. So I really encourage folks to buy, because interest rates are just temporary, but home appreciation, historically, it's going to happen.
Exactly. So, and someone had a question. Reggie had a question, which was it's kind of intertwined with my next question. Is it a decent time to buy with builders because they're giving incentives, but they're also showing that lower interest rate? So, how are builders able to give you that lower interest rate versus what the Fed is telling you what the interest rates are?
Absolutely, that's a great question. Thank you so much, Reggie. So the Fed interest rates and mortgage interest rates are different. So the federal funds rate that you hear, it's all the media loves drama, right? They're out there to entertain. That's what the media is they entertain. So Um, so the rate that they keep quoting, when you keep hearing the federal funds rate, the interest rates are going up, the Fed's raising the rate, they're not raising. They don't have control over mortgage interest rates. They have control over the federal funds rate, and that's the rate that banks can charge to each other to borrow money overnight. Those rates are what are tied to like prime, credit card interest rates, auto loans. That affects that industry. Mortgage interest rates are separate, and what affects mortgage rates are what's going on in the world. So that's, and there's a lot more to that, but in short, those are different. Absolutely, it's the best time to buy right now. Like Linda said, um, date the rate, marry the house, but we're going to add, and we're going to say divorce the rent.
That's right. So my question is this: if I was a buyer coming to you and
Mhm.
I filled out the application, I turned all the paperwork in, I was pre-approved, and you said,
Yeah.
well, you know what, your interest rate is going to be 7%, and
Uh-huh.
I say, well, this builder tells me that I could get a 5% interest rate if I
Yep.
use their lender.
Uh-huh.
What do you think some of the pros and cons are with using lenders that the builders provide to you?
Absolutely. That's a great question. What's really important is to read your paperwork. So two things. Read the paperwork, see where are you being charged money to get that interest rate? What's coming out of pocket? Is it coming from you, or is it coming from the seller, from the builder? So read your paperwork, ask that loan officer a lot of questions, and it's okay to get a second opinion. We encourage folks to get second opinions, because at the end of the day, that's how you can rest, at night, knowing, what, I made a really good decision for my family. I made an educated decision, an informed decision, because I didn't just go to the builder's lender, but I asked around. I asked a lot of questions. That's how we learn as a community, is to ask a lot of questions. I've done this for over 17 years. There's no question too simple, too silly, too small to ask me, because at the end of the day, this is this is going to be one of the biggest investments that you're going to make in your life, and we want to make sure that you're making the best investment. So is it, so absolutely check out the builder's lender, but I encourage you to also look outside the builder, because that builder and that lender, they have a relationship. But if you go to an outside party, someone that, Linda would refer to you, because we trust Linda, we know Linda, we love Linda. So go to folks that she's referring to, because these are people that she's also put her stamp of approval on, and she knows, likes, and trusts as well.
Thank you so much. Yes, and that is so true because that's what they're doing. At last earlier this year, last year, when COVID was in full effect, I should say, and it was competition where they were having raffles for houses for, well, I'm referring to new construction,
Hmm.
and they were not giving out any sort of incentives or dangling the carrot in front of
Yeah.
anyone's face at that time. And now, we they built so much, the market has changed on them, and
Yep.
they've been already in the process of building. So there's a lot of inventory, especially with new construction. So
Absolutely.
some new construction builders are saying, hey, we really need to get rid of our inventory.
Hmm.
And it's always a good thing to have a real estate agent on your side and also another lender on your side to help you navigate through that system, because they could be offering you, I've seen one builder offer $20,000
Hmm.
incentives, and they said we could do buy down. But with that $20,000, where is it coming from? Where are those fees coming from? Are they
Yeah.
padding it on another side, whereas you're not seeing it? And that's what happens a lot of times, is that they're really not giving it to you. It sounds like it, they are, but you have to know exactly what to look for. And that's why you should not go into a new construction or any sort of thing, especially when it comes to real estate, by yourself.
Exactly.
Hire someone that has the expertise to help you navigate through the system. Because if you go to Veronica and she say, okay, this is what I could do, and you go to the lender for the builder and they say, this is what I could do, you could reach out to Veronica and say, okay, look, can you tell me what's the difference between your loan and this lender's loan? And she can help break it down so you can see
Yeah.
which one is the best deal for me.
Absolutely. Absolutely. And you know what, Linda, that brings up a great, actually a great question that, or a great point. So the builders are incentivizing folks because, they have inventory, they have holding costs, right? It costs them money to hold on to these properties. So what they're doing is they have a choice. They can either they can apply that money in one of two ways. Either they can reduce the price of the home, or they can give you that money to use towards other things like a seller funded buy down or a temporary buy down. Let me give you an example. I did some homework in preparation. So let's take a house for about 450,000. Okay? That's an average sales price right now. I mean, you're seeing things all over but we're just going to use 450 as an example, okay? If a seller or a builder reduced the price of their home by, let's say, $10,000, the the difference in your monthly payment would only drop about 50 to $75 per month if they drop the sales price by $10,000. Okay. Let's flip it and let's use that money instead of towards dropping the sales price. Let's actually use it towards a seller funded buy down. Let's go back to that example: 7, 6, and 5%, right? So, year one, what you would save on a monthly basis would be $571. Do you know what I can do with $571? That's a whole car payment. Okay. Um, Year two, as you stair step into your next rate, your monthly payment would, the difference in the monthly payment would be about $292. Still, that's a car payment right there. That's groceries for, and gas for a whole week, week and a half, or maybe even 2 weeks, until you finally get into your final payment. So $10,000 right now, any money that any seller is giving you, make sure that you work with a lender that's going to sit and explain what are the benefits, what are your options. You can reduce the price of your home, you can use that money towards a permanent buy down, which is buying down your rate, or you can use that towards a temporary buy down where you stair step into your final interest rate.
So, question, because I know you're using temporary buy down and also permanent buy down.
Yeah.
How can you differentiate between the two, and how can
Mhm.
I do a permanent buy down versus a temporary buy down? What would be the process?
Absolutely. So a permanent buy down is a discount point. So if I take that's basically taking money. If you see on your loan estimate or a worksheet from a lender, and that's typically what you're going to see because the average lender, the average loan officer is going to show you discount points. Discount points, we've been talking discount points in high rate environments, low rate environments, any rate environment. Okay, so that's gonna be sorry if you hear kids in the background. Where this is life, right? So that's going to be a permanent buy down is the interest rate because your rate is permanent. That's the permanent rate for the life of the loan until you sell or until you refinance. Okay. A temporary buy down is when we take that money and we put that into the savings account, and you're going to see it's actually a separate line item on your worksheets where it there you're going to have the final note rate, and then the lender will share you with you, hey, we're going to take $10,000 or whatever that magic number is, and we're going to put it in an escrow account. It shows up on the worksheet, but again, make sure you're working with a lender, a loan officer that's going to explain those differences and say, hey, and ask them. I get asked all the time, "Hey, Ronica, are we doing a temporary? Are doing permanent? Are we doing discount points? What are we doing?" And I go through that worksheet line by line by line, and I explain to my borrower what we're doing, but also their options. Honestly, a lot of lenders are not talking about temporary buy downs or the seller funded buy downs because they really just don't understand it. So, but it's not a foreign concept. Seller funded buy downs have actually been around, or 2-1 buy downs have been around forever. It's just now there's a market need for it. So lenders are starting to talk about it more.
And you know what? In all my years, I've seen buy downs, but I've never heard any of my buyers say, "Hey, yeah, the lender said," but a handful of them that
Yeah.
knew about the buy down. So I'm
Yeah.
very particular on who I refer my clients to,
Yeah.
because a lot of times it's people that are first time home buyers, or people who are moving from one house to another house, but
Yeah.
their first lender didn't tell them that, or they've been in the home for 10 years or 15 years. And
Yeah.
that process is totally different now than it was
Yeah.
10 or 15 years ago.
Absolutely. Absolutely. The market was different 10, 15 years ago. Definitely.
Exactly, exactly. So we are going to go into our rapid fire
Let's
questions,
do it.
Veronica. Are you ready?
I'm ready.
All right. So these are the questions that Veronica's asked the most. So the first one, what's the minimum credit score I need to buy a home?
Yep, 580. That would be an FHA loan. Typically, when you see 620 or above credit scores, that's when we start talking about conventional loans. But 580 is kind of the gatekeeper credit score that you need to buy a house.
So should I just strive to get a 580, or should I strive to get the highest credit score I can get?
Highest credit score possible. And the reason why is because the better the credit score, the better the interest rate. Also, the easier it is to get approved. Great credit scores are not just for mortgages, they help you get a job, they help you get better credit interest rates on your credit cards, on your auto loans. I mean, great credit just is like the lifeblood right here, here in the US.
No. All right, question number two.
Uh huh.
It is, do I really need 20% down payment to buy a house?
You do not. So you can actually, as a first time home buyer, you can buy a home with as little as 3% down or 3.5% down. You can even look at a rural USDA loan if you're looking more in the rural areas. That's 100% financing. But regardless, you do not need 20% down payment to buy a home. To buy a home.
So even with conventional, I've seen where they changed it, correct, to instead of, because it used to be 20% down for conventionals a while ago, and they changed it to, is it 3.5 or 3%?
Yes, so on conventional, if you're a first-time home buyer, you can invest as little as 3%. If you've already owned a home for a conventional loan, you have to do 5%, but you still don't need 20% down payment.
And I've have a lot of people come to me and say, I want to do the USDA loan because
Yeah.
it's 0%,
Yep.
and they don't understand it. So I have to educate them on that. And when Veronica says rural, we're in Houston. So the Houston Metroplex is large. So rural doesn't mean that you're going to be living next to cows. Rural is I live not too far from Houston in Fresno. 10 minutes from me is the USDA, and there's it's new construction everywhere. And it's about 25-30 minutes up the road from downtown Houston. So don't think when someone says USDA rural that you're going to be farming. No, it is still a very populated area with new construction communities popping up. This is Houston.
Exactly. Houston's the only place where you can drive an hour and still be in Houston.
Still be in Houston, driving around in circles. All right, question number 3. With rising interest rates, is it still a good time to buy?
Absolutely. I can give you 10 reasons why it's still a great time to buy right now. What some of the most important and the biggest one reasons are, guys, as a buyer, you are in the driver's seat. You have plenty of inventory to look at. You've got sellers, whether resell or new construction, that are willing to help towards lowering your rate, helping you ease into home ownership. Pay less out of pocket. You don't, guys, if we were talking 3, 4 months ago, families were offering 30, 40,000 dollars over the asking price. They were paying more than what the houses were worth.
Mm-hmm.
Now you have more room to negotiate. It's a perfect time to buy. The only con, if you look, I have a great image on my social media. All the reasons why it's a great time to buy. The only thing that's on the con side is higher rates. But you know what? Date the rate, marry the house,
And
divorce the
divorce
rent.
rent. All right. And the next question, number 4. When can I refinance my loan?
Absolutely. You just need to make a few payments in the beginning, give it about 3 or 4 months, and then you are good to go to refinance your loan.
So that goes with the saying again. Date the interest rate, because 3 or 4 months, if you see something else that you like,
Yep,
you could get that new rate.
you sure can. Mhm.
All right. Next question. How do you pick a good loan officer? This is a great question.
Absolutely. So, pick someone that is visible, that has experience, but is also willing to be patient and explain things to you. Whether we have low rates or high rates or wherever market we're in, this is going to be one of the biggest purchases of your life, one of the biggest financial investments, and we want to make sure, as loan officers, I can't speak for everyone, there's not every realtor is the same, not every lender is the same, but pick someone that is going to explain things to you. Do we Are we available, when you are as well? Yesterday I had an incoming call. I was at my son's soccer game on a Sunday, and I had an incoming call. Someone was like, "Hey, I have a question for you." And I picked up the phone, and they were like, "Hey, I'm sorry to bother." I said, "No, no, no, you're not bothering. If I answer, it's because I'm available." And I said, "I'm sorry if you hear kids in the background. We're at a soccer game." And they're like, "Oh, I'm so sorry. I'll call you back." I said, "No, no, no, no. This is important to you, so it's important to me." So pick someone that again is willing to explain things, has is available for phone calls. Doesn't I don't have a schedule. We work start to finish. My only boundary is Sunday morning. We take our kids to church and then to Luby's.
Tradition, tradition. Well, thank you so much, Ms. Veronica. We have a couple of questions
Yep, I'm here.
that they have comments. So someone wants to know, they said that they have a couple of charge offs on their credit. They're waiting for them to fall off.
Mhm.
When is it normally a good time for them to purchase a house? Do they have to wait till they fall off, or is it so many years, or what would you advise them?
Definitely. So, gratefully, we have loan options available to help our families that have a few nicks and bruises on their credit report. I'm human. You're human. Life happens, right? Sometimes things happen that are out of our control. So just because you have collections and or charge-offs doesn't mean that you cannot buy a house. I don't want to get too technical, but on for an FHA loan, for example, FHA says if it's a charge-off, we don't even need to consider it part of your debt. If it's a collection, things are looked at a little bit differently, but very rarely do we actually even have to ask you to pay off a collection or a charge off. With a charge off, the creditor has already written that off as bad debt anyway. So at some point in time, it's going to fall off. But don't let bankruptcies, foreclosures, judgments, tax liens, collections, things like that stop you. It's always a great idea to allow a loan officer to review your credit report so that we can also look at it and say, hey, you know what? It's actually not as bad as you thought.
Good answer, because I do get a lot of individuals
Mhm.
who have say they have credit issues, but they assume they have a credit issues because that's what they see on their credit report, and they don't know how a loan officer would view it versus a normal person's eyes. I could say a normal person's eyes, because they see a charge off and they say, "Oh, well, I have to wait till it fall off," and now they know
Mm,
they don't have to wait till a charge off falls off, because different loans and different lenders have different programs. So there's never a one size fit all program, and that's the important thing about finding the right lender
mhm,
and talking to different lenders, because every lender is there. Lenders are not the same, so you have to find one that has a program that fits you and that can communicate with you and
mhm.
answer all your questions, that are patient with you.
Yeah, exactly. Yes.
So one last question.
Uh-huh.
Mr. Malcolm is in New York. He's stating that the homeowners insurance has gone up.
Mhm.
Is it a trend? And if it is a trend, what do you think is triggering that trend?
Absolutely. So I like to stay in my lane, so I'm not going to give too much specific about home insurance, but we do I notice because my clients get quotes throughout the home
Mhm.
buying process, right? You can't close on your house without it being insured. So yes, I have noticed that insurance rates are rising. It really depends on what's going on. We're in Texas, we're along the Gulf of Mexico, so as hurricanes happen, and insurance companies have to dip into that money into the reserves to pay out claims. At some point in time, they've got to refill that bucket, right? So yes, I have noticed. Make sure that you connect with you actually don't have to stick with one insurance company. Even as a homeowner, you're not tied to an insurance company. So a good rule of thumb is that every year on your home anniversary, or as you're shopping, or you're in the process of buying a house, we, the lender, advise you to shop around. It doesn't. They don't even run your credit like a hard inquiry. It's just a soft inquiry with an insurance company. So shop around. As a homeowner, you don't have to stay with your insurance company. You can shop. I look at the anniversary of my home closing. I say, oh, it's January. I bought my house last January. I need to look at my insurance. Just to make sure it's staying competitive. Nowadays, you don't see a whole lot of discounts for having your insurance with them for 20, 25 years.
Yeah.
Nowadays, I mean, everyone's shopping everything, right? If I see something at Walmart or at Target, I'm shopping Amazon. I'm like, hey, can I save a couple of bucks, right? So just shop around. Hmm.
And this is going to be the last question for real
It's
this
fine.
time.
It's okay.
So now, with debt to income ratio, we know that recently the student loans are looked at differently. Can you briefly explain, if you look at someone's credit report and they have student loans, how do you view that, and what's the best strategy for them if they're thinking about buying a home?
Absolutely. So student loans, that's a very common question. I think if I would have given you six rapid fire questions, that would have been question number six, is how does student loans affect me when I'm buying a house? So it depends. If you have a good idea is to get an income base. If you're not already in repayment with your student loans, which a lot of folks are coming out of COVID, they're starting to get back into this repayment mode. So look at getting an income based, and it's called an IBR, the income based repayment plan, where the student loan providers will give you a payment plan based on your income, not necessarily just, take the loan divided by 360 or whatever it is. When it comes to getting you approved for your mortgage, depending on if we're going conventional, FHA, USDA, like which route we're going, if you do not already have a payment plan in place, we have to assign a monthly payment to that debt. So, depending on the loan, sometimes we'll calculate 0.5%, sometimes we have to calculate 1%. But again, if you have that payment plan in place, that would be super helpful to the loan officer. With this new student loan forgiveness plan, we on the lending side are still waiting for feedback on the rules that we need to follow with student loan that's going to be forgiven. That's still kind of in the works, but we should have something on that soon.
Well, I want to say thank you so much, Ms. Veronica, for joining us today and informing us about the buy down versus the price reduction. So I hope a lot of people know the difference and rethink it. And if they're currently under contract and they haven't closed yet, they could at least speak to the lender to say, hey, what about a buy down? Um,
Exactly.
and if someone needs to get in contact with you, can you please give them information on how to reach out to you?
Absolutely. So my cell phone, 713-263-4165. 713-263-4165. I'm also on Instagram as home loans by underscore Veronica.
Thank you so much. And I want to thank everyone for joining us today. I hope you guys enjoyed the live about the buy down price reduction. So make sure if you want us to come back and have more questions, let me know. And I could ask Miss Veronica, she'll come back for round two.
I'll be back.
Thank you guys so much. You all have a wonderful and blessed day.
Thank you, Linda. You too.
Bye bye.